with us today, we've got John, Managing Partner, RDG, myself, Dan Matteo, Partner at RDG, and our special guest today, Chris Gamble, Managing Partner here at RDG. So we're excited to have Chris on board. He's going to go over some of the tax updates for us. Quick note on technology. I really appreciate already all the issues you guys are letting us know through the chat. That's what the chat is for. If you can't hear people, throw a comment in there. Shelby will give me the side eye, and we'll try to get it fixed real quick. If you guys have questions, throw them in the Q&A. If somebody else has a question that's like yours, just like their question, and then the more people that like a question will answer it. Those will be first. And then, of course, the slides and a recording of today will be handled after. Shelby will get that all set out for you. So with that, I'm going to throw it over to John.
Great. Thanks, Dan. Thanks for everyone for attending. We know you have busy schedules and things going on, and this probably isn't the most important thing for you, but we're glad that you're spending time with us today, and we're excited to bring some updated information on what's happening. We're also excited to have Chris Gamble join us today. You notice the nice hair. Free-flowing hair we brought to you today, and we don't have an NFL star, I'm sorry, but Chris is pretty close to that. So we're excited to have some tax information today. Staying safe and healthy. We know that we're dealing with a health crisis here, and we're just trying to help on the economic part of it. So hopefully everyone's staying safe, staying healthy, following all the rules of washing hands and keeping your distance and social distancing and all the things that we're hearing about. And our thoughts and prayers go out to anyone that's been affected by this. Special thanks to our research team. We have our two nerds here from RIT, two of our partners, Brian DeJaco, Tim Hearn, behind the scenes answering questions again. We've added Ryan Lynn McCullum. Ryan Lynn is a tax director in our office, and she's going to be answering some questions on the tax side. There are quite a few tax goodies that may have gotten overlooked in this CARES Act that could provide more relief to you than the PPP or the loan product. So we're going to give you that today as well. So thanks to our research team. All right, here's our agenda. So we're going to start with the latest news. The SBA has actually been updating their site. Actually, the U.S. Treasury site has been updated on almost a daily basis. You're not answering every question that we have, but we're getting some clarification. Chris Gamble is going to go through a tax update, things that I mentioned previously, all the pending guidance. So we're going to give you, we're getting a lot of the same questions that we more or less can't definitively answer. So we're going to give you our best guidance and interpretation based on what we know today. We're going to go through the rules on forgiveness and go through another example here so that you're all understanding what you need to do to ensure that your loan is forgiven on the PPP. And then we're going through Q&A as we go, and then we'll take some live Q&A towards the end of the presentation.
Great. So with that, I will get into the latest news. So reminder of the players. We've got Treasury, SBA, the Senate, the President, and the House. So we'll be going through some of these guys that have been tweeting out lately and what's been going on. Reminder that on April 16th, funding ran out on round one, $349 billion. By April 21st, the Senate had introduced legislation for an additional $310 billion, $250 to everybody, and an additional carve out of $60 billion to small lenders. That was then passed by the House on April 23rd, and it was signed into law by the President on April 24th. By April 27th, the SBA resumed accepting applications 3 days after it was passed into law. So that was good. And after the first day, second round, nearly $50 billion more in loans in the first 24 hours. You will have noticed that, and another good point from the SBA actually is that $2 billion of the first round funding was either declined or returned, and therefore they added that into round two. So it's 310 extra billion into round two, and 2 billion from the first round. It's really 312. So that was good to see. Rubio tweeted out, he's kind of been at the front lines, letting everybody know. Obviously, it had some glitches, but in positive news, 475,000 small business loans approved in the first 26 and a half hours, and the average loan this time around was 111,000. So it looks like they're getting to smaller businesses in round two. Some things that you may have noticed or heard about in the news is that they've been trying to get this money into the hands of community banks so that they can get to smaller borrowers, smaller businesses. So what they did is they put a pacing system in place, which meant that each bank, every bank, no matter your size, could only submit 350 loans per hour, which obviously hurt the bigger banks like Chase and Wells and Bank of America, et cetera, and helped out the smaller community banks. And then they further tried to help community banks and smaller institutions and said between 4 p.m. yesterday and midnight that they were only going to allow loans from banks with less than $1 billion in assets to be submitting during that time period. So with that, we are going to kick this over to Chris Gamble, who's going to give us the major tax update.
Today, I'm going to share with you some of the tax provisions that were part of the CARES Act. We obviously know that the federal government has made significant efforts to put money back into people's hands, whether it's a stimulus payment, whether it's relief on payroll taxes, whether it's the payroll protection loans, the economic injury loans. There has been a lot of actual money that the federal government has been printing and putting in people's bank accounts. In addition to that, the CARES Act contains many different tax law changes that are actually beneficial with the same intent. Let's get money back in people's hands, whether you're a business owner, you own a business, you're a member of a partnership, an S Corp. There are a lot of rule changes that, again, what's the point here? Let's get money back into the economy. So I'm going to talk about 4 major tax law changes today. But first, I'm actually going to talk on a topic that has kind of come up. It's been getting some attention recently and kind of share with you our thoughts on this. And it's the slide here is labeled PPPL taxability. So we know that in the CARES Act, the receipt of funds from the payroll protection program is not taxable. It specifically says that, whether it's forgiven or not, it is not taxable. The CARES Act does not comment on whether or not the expenses you use to pay with those funds are deductible. I'm not really certain if Congress was thinking about this when the law was passed, but regardless, there is a question in the tax community about how this is going to be handled. So again, CARES Act, receipt of the funds, not taxable. Question, are the expenses used to pay, the expenses paid with PPL funds deductible? This all deals with the Internal Revenue Code section 265, which is actually titled deductions related to tax exempt income. There are several cases. They're not very recent cases, but there are several cases. We've got 2 of them listed here where individuals or businesses were reimbursed from a federal loan program. They then filed their tax returns, claimed deductions that were paid with those funds. The IRS challenged them, audited them, claimed 265, and the IRS won. So we need more guidance on this. And I understand that as we're working through our 8-week period here, people have funds. There's a question, am I going to be able to deduct these? Who's going to give us this guidance? Is it the SBA? I don't think so. SBA is administering these loans. This is guidance we're waiting for from the Treasury or Internal Revenue Service. Just one thought. If you receive tax-free income, you use those funds, you get to deduct everything you pay with those funds. If those funds push you into a loss and you're eligible to claim, carry back that loss, which I'm going to talk about, in theory, you could be getting a triple benefit. So there is precedence for IRS doing this. We're hopeful that Congress will say, we really need the economy to get started up again, and we're going to allow these deductions. But we've been saying from the beginning, make good business decisions. I would argue that even if the deductions are not allowed, I'd rather somebody gave me $1. I had to pay 40 cents in taxes on it, but I was able to use that 60 cents on something else. I think you're still ahead of the game, even if it's not deductible. but we don't know at this point. Something to watch. We're watching every day. As soon as we know, you will know. So now I'm going to move on to these, again, 4 major provisions related to business owners and businesses. They are net operating losses, changes to qualified improvement property, excess business, and business losses and limitations on interest expense. Those are 4 things we're going to hit on today. So first one, net operating losses. What is a net operating loss? A net operating loss is when your expenses exceed your income and you have a negative bottom line. This can happen for a corporation. This can happen for an S Corp, a partnership. This could happen for an individual who has his own business, a single member LLC or a sole proprietor. If you have negative overall income, you have a net operating loss. Prior to the CARES Act, net operating losses had limitations on them. You could only carry it forward. So if you incurred a loss in 2019, you could only get a benefit from it beyond 19 in 2020 or future. In addition, you could only offset 80% of that future year income. CARES Act wiped that out. And it basically said for losses arising after a year beginning 12/31/17 and before 1/1/2021, you can carry back the loss. So if you're a calendar year taxpayer and you had an NOL in 18, 19, or 20, the rules just changed. You can carry it back up to 5 years and shelter prior income and receive a refund of prior income taxes paid. So 5 years. If we incurred a loss in 2018, you can go all the way back to your 2013 tax return, and if you had income and paid taxes, we can get that refunded for you. The other changes, again, the carryback can offset 100% of the prior income. Losses incurred after this will go back to the rule, the old rule, but the NOL is probably the biggest change, and the next 3 changes I'm going to talk about all can funnel into the NOL and increase the NOL. So, do you have a loss in 18, 19, or 20? If the answer is yes, and you paid income taxes in prior years, you should be talking to your accountant about filing for a carryback and receiving prior taxes paid back as a refund. The next item I'll talk about is business interest expense limitation. Again, under the old rules, there was a limitation on the amount of interest expense certain businesses could deduct. The certain businesses was if your income for the past 3 years averaged more than 25 million. If you had a lot of commonly owned or several commonly owned companies, they had to all be aggregated. So yes, this applied to larger taxpayers. The rule was your interest expense cannot exceed 30% of your taxable income. The CARES Act changed that for tax years 2019 and 20, and they're now allowing 50% of the interest expense to be deducted. So, if you file your 19 return and you had a limitation on your interest expense, you should amend that return and you will be allowed additional interest expense deductions. What can that mean? Well, if you will pay tax in 19, you're going to reduce your taxable income. Let's say you were at a break-even point, even with the interest limitation at its prior amount, 30%. We amend, you get additional 20% of your interest, you create an NOL, we go right back to that first concept, we carry it back. Let's carry it back to prior years, get a refund of prior taxes paid. Now, one caveat on this is if you are a partner in a partnership, the rules are a little different. The expense limitation is actually calculated on the partnership return. If it's determined there's a limitation, it's passed out on the K-1. If that happened to you in 19, you will be able to deduct 50% of that limited amount in 2020. So that one you have to wait a little bit on to be able to receive that benefit. Lastly, with regard to this change, for 2020, you can use your taxable income in 19 to calculate this 50% amount. The thinking here is there will be a lot of businesses that do not have as much income in 2020 as they did in 19 due to the downturn in the economy. So you can use the limitation for 19 and 20. It's both based on the 2019 taxable income. Again, get some more interest, either shelter current year or carry back, get a refund. The third item I'm going to talk about is qualified improvement property. This is another big one. If you own real estate, if you lease real estate, this can be a very significant benefit for you. First, let's talk about what qualified improvement property is. The definition here right in the middle of the slide I'm going to read. Any improvement made by the taxpayer to an interior portion of a building, which is non-residential real property, if such improvement is placed in service after the date such building was first placed in service. So let's break that down. Number one, not residential property, has to be commercial property. It's property you lease to a business, or it's a property that your business leases. If that is the situation, the old rule, there was actually an error in one of the prior tax laws that said this type of improvement has to be depreciated over 39 years. When that happened, it was not eligible for bonus depreciation, even though that was the intent. The CARES Act fixed that, and they said qualified improvement property is a 15-year asset. That makes it eligible for bonus depreciation. You can get 100% write-off of your qualified improvement property in the year it goes in service. So I'm a landlord. I had a commercial tenant. For them to enable to get them to come into my building, I had to move some walls around. I had to build them a new conference room. That would certainly qualify as qualified improvement property. This applies to qualified improvement property placed in service after 12/31/17. So we've got 18, we've got 19, and we certainly have 2020 in this also. If you are a tenant and when you moved in to commercial property, you paid to build that conference room, to move the walls, to make a change to the floor plan, all of those dollars can now be 100% written off. You will likely have to file some amended returns, do some carrybacks, but this could be significant. I will share that in our client base, we have a good number of real estate clients. We've already prepared NOL carrybacks related to this that are producing refunds in excess of $100,000. So there's real money here for sure. Lastly, there is excess business losses. This was, again, a limitation in a recent tax law. An excess business loss does not apply to C corporations. It applies to partners and partnerships. It applies to shareholders and S corporations, and it also could apply if you were a sole proprietor, a single member LLC. The rule basically said, if you are allocated a loss and you have basis, you're able to deduct that loss, we're going to limit it. And the amount for 2018, it depended on your filing status. For single, it was $250,000. For married, joint, and other statuses, it was $500,000. So if I got allocated a loss in excess of that, I could only deduct up to this amount. The rest of it became a net operating loss, which under the old rules, I had to carry forward. So if I'm a partner in a partnership, and in 2018, the partnership had a $2 million loss, I'm a 50% partner. I was allocated $1 million of loss. When I filed my 2018 return, and I'm married joint, I only deducted $500,000 of that loss. Under the CARES Act, you can go back to that 2018 return. If you filed 2019, similar situation, you can go back. Sorry about that, my phone just died. So I was saying, if you were allocated a loss in excess of these business loss limitations, you can go back, amend those returns, claim these additional deductions, shelter income in the year that you were limited, and potentially generate a net operating loss to be carried back to prior years and receive additional funds back. So, again, this is a quick overview. It's not meant to be a technical explanation of all these. It's just meant to give you an idea of the type of situations that you can benefit from these CARES Act. Again, let's put money back in the economy. Let's get things moving again. So, how would you proceed? I just gave you all that information on these 4 major tax changes. There are many others. And hopefully we'll get to cover those in a future session. But what should you do? The first thing you should do is review your prior year returns and your current year returns with your accountant. Talk to them. There are a lot of benefits for you to take advantage of. All these changes I just talked about are federal. So you have to consider the state impact. For example, New York has decoupled from these net operating loss rules. We might be able to carry back 5 years for a federal return. We're not going to be able to do that for New York. Other states, some have conformed with the federal rules, some are different. Proper planning in this current year. Even though you may qualify and you may have a net operating loss, you might want to choose to elect out. Let's say, for example, you were in a low tax bracket back in 2014, 15, 16, but you're fortunate enough that you're going to be in a higher tax bracket going forward. You want to get the most bang out of the buck for those NOL losses. Other things that we've been doing with clients, I'll just share with you quickly. We've been doing cost segregation studies for people with real estate purchases. Why? We get shorter lives assets. We get to take significant depreciation, shelter current year, carry back. Roth IRA conversions. Your income is low. You're in a low bracket. Let's convert a traditional IRA to a Roth. We'll deal with the taxes now. It might be sheltered by losses. You'll never pay taxes on that again. Capital gains. If you can get your income down low enough, there is a possibility of 0% capital gains tax bracket. So, if you're a current client at RDG, we are looking through your returns and dealing with all of these possible opportunities for you. If you are not an RDG client, we are happy to give you a free review of your returns. You want to send them in, we'll look them over, we'll share with you these ideas and others and give you an idea of the potential benefit and help you move forward. So again, a lot of opportunities here in the tax law with this CARES Act, and happy to provide you this quick overview.
All right. Thank you, Chris. With that, we're going to get into pending guidance. John?
All right, thanks, Chris. And yeah, as you can tell from what Chris presented on, it gets pretty complicated. And I would say don't try that stuff at home. It can be dangerous. But we have several clients that have applied and will get back over 6 figures from these different tax law changes. So, all right, let's shift gears now back into the PPP. So we're getting a lot of questions. So what we thought we would do is provide more guidance, and this is more guidance / opinion versus strict law out of the CARES Act. Because as a lot of you know, some things aren't very clear. So we want to kind of try to give you some guidance on the areas that are not clear. We did have a call with the SBA local office this week and did review these questions. And basically their advice was that they did not have any additional information outside of what's been posted online. So it wasn't a big help, but we did have some discussions with them and have a little bit of direction on some of these open items. So items we're still waiting to clarify. I need more guidance. Number one, we're getting a lot of questions. I can see the questions already here from today. Can I prepay? Do I pay my payroll based off of pay date? Is it based off of days worked? So our advice is that you don't pay any more than 8 weeks of payroll. Okay, so whether it is, whether you're using a payday or the actual days worked and they're paid maybe at some other date, our recommendation and advisement is to not pay any more than 8 weeks. That also holds true for rent. We're getting a lot of questions that, can I prepay rent? Can I pay old rent? Our advice again is not to pay any more than 8 weeks of rent. So you may have to prorate. Your rent payment obviously is going to be what your rent payment is. So when you prepare your forgiveness calculations, you want to make sure that you're limiting yourself to 8 weeks. Now, from a rent perspective, that's more or less 2 months, but it isn't exactly 2 months because it's 8 weeks. So again, our recommendation is to only pay 8 weeks for both payroll and for rent. Limits on increases of compensation. So we first presented, on something that was floating out there about capping any compensation to 125% of what individuals were earning before. We have not seen any guidance on that whatsoever. So our recommendation, again, this is our guidance. We do know that you have to pay your employees at least 75% of what they are earning last quarter. So our recommendation is if you do pay somebody more, and there isn't guidance, there isn't a cap on how much more you can pay somebody as of right now, but if you do pay somebody more, our recommendation is that you cap that at 25% more. We're just using an assumption here that if they're allowing you to go down by 25%, logic tells us that they'd allow you to go up by 25%. Does that mean we're correct? No, it doesn't. That's our guidance. I already talked about expense catch-ups and prepayments. Keeping people past June. So we get a lot of questions about, hey, what if I hired everybody back by June 30th and then fired them all on July 1st? Well, the intention of the Paycheck Protection Program is to employ people, not to get rid of people. So our guess is that there's going to be some sort of look back, and there is a 60-day window, forgiveness window, where your forgiveness is approved and you apply for forgiveness. Our advice would be at least during that 60 days that you want to keep your people on. However, that's a business decision as well, so you have to decide if that's what you need to do for your business. But our advice is try to keep people on. How many hours is an FTE? We've heard 30, we've heard 35, we've heard 37. We're going with 30. 30 is what was used under the Affordable Care Act, which is the most recent guidance we have, where the government has referenced FTEs. We told a lot of our clients to calculate it both with 30 and 35, but we're guiding you right now and say, hey, 30 is what we've seen used the most. Rent for vehicles and equipment. So we're getting questions like, hey, beyond the rent I pay for my facility. So the Act does say that rent is included for both personal and real property. So real property is easy. That's your office building, that's your facility. Personal property would include items such as vehicles and equipment. So our guidance would be that items like copier leases and vehicles and equipment and other personal property, because it references personal property, those items would qualify under rent. And the last item is here. Do new hires count for the FTE calculation? The answer there is yes. They're encouraging hiring. So if you're hiring someone for the first time during this time period between now and June 30th, they would include as part of your FTE calculation that you will do after the 8 weeks. So here's some more guidance. One other question that we're getting is on the EIDL as well. And I think, Dan, we're going to talk about that in a minute.
Yeah, actually, perfect lead-in to the EIDL slide. So with the EIDL, if you remember, SBA email came out and said that the advance will provide $1,000 per employee up to a maximum of 10 grand. So it's not 10 grand, number one. It's up to 10 grand, and it's based on the number of employees as of January 31st. Secondly, there were three processes for applying for the EIDL loan. First, it was online, and you had to upload loan documents and schedules of liabilities and financials and tax returns, etc. That site crashed, so then they moved to paper application. That was phase 2. So you'd submit the same schedules and financials and all that information via paper, just one upload. Then they scrapped all that all together and moved to a simple 5-step process where he basically said, I want a grant and contact me later about a loan. For the people that submitted via the first round on the website, we've seen some of those people get funded already for significant amounts, 30-year terms, 3.75% interest rate. For the people that submitted via paper, phase 2, they're just starting to get contacted by the SBA for approval. We've seen nobody in the phase 3 application that applied for the grant get approved for that. So we've seen a lot of people get their grants. Everyone should start to see those grants coming through if you haven't already. But if you were in phase 3, then it's unlikely that you've heard about your loan. If you're in phase 1 or 2, that's more likely. Partners, this is a topic that comes up a lot. We're partners, and obviously we only take draws. Can we include any part of our draws? So that came out in the interim final ruling on April 14th in the self-employed rule that basically said self-employment income of general active partners may be reported as a payroll cost up to $100,000 annualized on a PPP loan application filed by the partnership. So very important there. What we don't know is you could have included that on the application. We assume that you could include that in the forgiveness calc, but nothing actually has come out on that. So we're still waiting on that, guys. Timing. This one came out on the 28th. Can a borrower take multiple draws from a PPP loan? No. The answer is no. It all has to be in one full disbursement. You typically have 10 days. If you had a loan number prior to April 28th, then your 10-day period starts on April 28th. So there's some rules around it, but generally one disbursement within 10 calendar days from when you've been approved by the SBA. They wanted to get this money out. Certification, this one's been all over the news. Shake Shack, Harvard, the Lakers, all these people. A reminder from the SBA that you're certifying that you must assess your current economic need for a PPP loan. We maintain that most of you can continue to certify that there was uncertainty, that you've been impacted, etc. But obviously it's a facts and circumstances certification, and you should review that with either us or an attorney or someone, relatively soon if you think that you're in jeopardy of that you shouldn't have taken it. SBA review, this kind of goes along with that in that the SBA has decided that it will review all loans in excess of $2 million. So another thing to pay very close attention, if you got a loan that's over $2 million for payroll, the SBA is going to review it, all of them. So be prepared for that. Doesn't mean that you should be scared by that, just be prepared for that. That's another reason, use your advisors, use us, reach out to us, and make sure that you have all your ducks in a row and you're filing all the latest guidance. Change in control. This is another question that came up. If you bought the business, if you plan on having a change in control, you sold your business, whatever, if there was a change in control, as long as the business was in operation as of February 15th, it's eligible to apply for a PPP loan regardless of that change in control. So all they care about are employees. If employees had a job at your company prior to February 15th, they want to get them back to work. So they're not so concerned about who owns the company, just that employees get their money. Okay. Rules on forgiveness. John's going to go through, the basic tenets of the rules of forgiveness. We've gone through this every week. I'm going to re-go through an example, and then we'll get, we've answered about 40 questions so far, still have a couple open. We'll get to those in just a second. So we're running, we'll try to keep this to 45 minutes.
Yeah, thanks. One more thing to add on. We've talked to a lot of people about the timing, and not everyone's happy with the timing of receiving their money because they're not open yet. They're not able to bring people back yet because of a state order or whatever the case may be. The SBA kind of addressed that. They seem to not really care at this point right now. And if you stall receiving your funding, you can't stall beyond 20 days from when your loan was approved. So the bank has 10 days to fund you. You have 10 days from their 10th day in order to close on this and provide all the necessary information. You got to be very careful, because if you go beyond that time frame, the bank's instructed to cancel your loan. So you got to be careful about that. All right, rules on forgiveness, like we've said before, it's a business decision first. I've talked to a lot of businesses that are trying to bring people back. I talked to somebody earlier this week that brought quite a few people back, and they have nothing for them to do. So that might not have been the best decision, but the business decision is the first decision. If you don't need people, don't hire them back. If you need them, hire them back. Forgiveness. All right, so we're going through these goalposts that we discussed last week. Number one, spend the money, right? Do you have to spend the money? No. But if you're looking for forgiveness, you have to spend at least 75% of it on payroll, and you can't spend any more than 25% on rent, utilities, and interest on your debt. Your time period, you have 8 weeks to spend the money. For a lot of people, that clock is already ticking. Some of you are already in, the end of your second week. So you only have 6 weeks left. Starts the day you're funded for 8 weeks.
Good point on here, John, too, is a lot of people have asked, do I have to spend 75% of my total loan amount on payroll or 75% of the amount that I apply for forgiveness? We continue to maintain that if you got $1 million loan, it doesn't necessarily mean you have to spend $750,000 on payroll, but if let's just say you spent $100,000, $75,000 of that has to be on payroll when you apply for forgiveness. So an important point there. Again, don't have official guidance on that, but 75% of what you spend has to be on payroll.
All right, so now the next requirement that you have for forgiveness is maintaining employment. So we have our base period. You can select one of these two. This you should already have by now. What were your FTEs on one of these two base periods? You then compare that to your FTEs, the average FTEs over the 8-week period. Now you have two numbers. Now, the SBA is allowing you to add people between now and June 30th. If you add people, they're removed from both your base period and your covered period. So they more or less would count the same as if you had them in both periods. I just had that question today. There's a lot of confusion there, but it's pretty clear that you have until June 30th to increase your number of FTEs. Say you get to the middle of June and you still haven't gotten your FTEs to one of the base periods. Then it's very important that you really consider adding some people back in those last couple weeks of June, right up to the last day of June, in order to meet this criteria. And we'll be going through an example to show you those details. Next item, you have to maintain compensation. So I talked about this on some of the clarifying items. No employee can earn, they have to earn at least 75% of what they are earning before. Right? So you can't drop their compensation by more than 75%, and that's compared to the most recent quarter, which would be the quarter ended March 31st.
All right, so with that, we're going to go through that example again just to make sure that we hammer this one home. So, facts, loan amount, $2 million. We spend, over our 8-week period, $350,000 on payroll, which is not 75% of loan, it's just $350,000 on payroll, that's what we spent. Non-payroll, rent, interest, utilities, we spent $390,000. So we spent $740,000 over our 8-week period. So we did not spend our entire loan, spent $740,000. Because we only spent $350,000 on payroll, we can only spend $116,000 on non-payroll items. So the point is, spend the majority of the money that you ask for forgiveness on payroll. So that means if I spend $350,000 on payroll and I'm only allowed $116,000 for non-payroll, my total eligible for forgiveness is $467,000. So in my baseline period was 180 employees, full-time equivalents. Over the 8 weeks, because I only spent $350,000 on payroll, I only had 40 employees, which means I only had 22% of my workforce back. So I take the total eligible for forgiveness, 467, multiply it by the 22%, and that's the amount that can be forgiven, $103,704. So, as John mentioned, we then decide to trigger the June 30th clause, and by June 30th, we have everybody back. So even though over the 8-week period, we only had 40 people, when June 30th hits, everybody is back. So if everybody is back, that means that they disregard the fact that you only had 22% of it back over the 8 weeks, and therefore 100% of the total eligible for forgiveness is now eligible for forgiveness, meaning $467,000. In the next example, we say, okay, we had 40 employees in our first example. In the second example, we're saying, well, what if on the first day we had 63 employees? And that additional 63 employees over 8 weeks cost us $200,000. So now our payroll before over the 8 weeks was $350. Now it's $550. So an extra $200,000 in payroll costs. If we had 63 employees and our baseline was 180, then we only brought 35% of our workforce back. So our total eligible for forgiveness is the $550 we spent in payroll plus 25% in non-payroll, which is $183. So we have $733,000 eligible for forgiveness. Multiplied by our workforce retention factor of 35% means that our debt forgiveness is $256,000. So compared to if we only had 40 employees over those 8 weeks, we got $256,000 in debt forgiveness, which is an additional $153,000, but it cost us $200,000 to do that. So that was a bad strategy, is to hire those extra 23 employees back on day one. Now, if we hired 23 employees back on day one, and by June 30th, we had our entire workforce back, that means we spent an additional $200,000 in payroll. So we spent $550 in payroll. We brought 23 extra people back from our first example, and everybody back by June 30th, meaning that the entire $733,000 will be forgiven. So if we compare what we would have gotten if we had hired 40 people back on day one compared to 63, and in both cases, everyone was back by June 30th, we got an additional $267,000 of forgiveness, and it cost us $200,000 to do so. That's a good decision. So again, important strategy here. That's why people like us, RDG, is here to help advise and help once we map out that flow of funds. Is this a good decision or a bad decision? But in any event, it's very important to do that. And our reminders for strategy are use your money efficiently. So don't forget to review the strategy. When do you rehire employees? Prepare a flow of funds. And don't forget, any balance is payable over 2 years at 1%. So it's not the end of the world. That's why it's important to make a good business decision, is because if you spend the money, and we're going to spend the money, and a portion of that gets forgiven, great. Any balance that doesn't get forgiven is just a loan. You can pay it back. We were supposed to get guidance by the 27th. That we got minimal guidance, so more is expected. And then obviously you want to coordinate with the EIDL. So an important note on the EIDL is if you got the $10,000 or up to $10,000 and you had $100,000 of PPP forgiveness, then the PPP forgiveness is reduced by the EIDL grant. So then only 90 would be forgiven and 10,000 would be a 2-year loan at 1%. All right. With that, we have some Q&A. So we've answered about 50 questions. We are right at 45 minutes. So we're going to take a couple live. We'll continue answering after this, and I'll stay on for a couple minutes. So we'll answer a couple questions live, and then you guys can feel free to go about your day. So first one that we have here is, what happens if my employees do not wish to come back because they're making more on unemployment? Looks like we actually answered that one as I was going to answer myself. Oh, nope, still there. So if people don't come back and you don't pay them, then you can't include them in the FTE calc, and you also can't include them in what you spent. So therefore, you would not be able to include them in the amounts that you spent or in the workforce retention.
There's a question here on the EIDL, and Dan talked about this a little bit. We submitted it for our EIDL grant on April 1st, have not received the 10K grant yet. Any advice? I would just say be patient. We're seeing grant deposits still being made. There's a lot of volume that's gone through there. You could try to contact the local office. However, I'm not sure they'll even be able to help you. But like Dan mentioned, that application's gone through 3 revisions. And if you just did the last online application, what's going to happen is you will see a deposit into your account unless there's some issues that they've come up with your account number or prior SBA debt issues that you had. And then the SBA loan piece, we're assuming that you'll be contacted, within the next month or so to process the EIDL loan portion.
All right, another question from Irene. How is the 116,667 determined? Great question. So again, if 75% has to be spent on payroll and 25% on non-payroll, you would take the total you spend on payroll, divide it by 75%, and that's the maximum that can be spent. Multiply that by 25%, and that's the maximum amount of non-payroll that you can spend. So again, always start with what you spend on payroll, divide by 75%, multiply by 25%. That's the max you can spend on non-payroll.
I think we've covered most of the questions. A good
Yeah.
job by Brian and Tim, Ryan Lynn, cranking through the questions. So we don't have as many live questions to answer here today. We will be releasing the presentation as well, so you can view that. And as always, you can send us an email with any questions or contact us.
All right, with that, we do our typical send-off here. We replace Bruce, who is that guy anyways, with our favorite guy, Luigi. Everyone stay strong. Thanks for joining us today. Reminder to always join us Thursdays at 1:30 for the Stay Strong webinar series presented by the Hustle Firm. Today you have John, myself, Chris. Thanks everybody for joining us, and stay strong.